Hello everyone and welcome back to This Week in the Markets, and we hope everyone had a great holiday break. Now, over the holiday period, the US government managed to reach a last-minute deal to avoid falling off the fiscal cliff. Economic news reported during the last few weeks were also quite positive for the US economy. However, the Fed made a dent in sentiments as the latest minutes suggest that some officials are considering ending the QE3 program in the second half of 2013. In Japan, the new Prime Minister is seen taking on more aggressive actions to stimulate the economy and to weaken the Japanese yen. So we'll go through our disclaimer briefly and then we'll come back and discuss this news in more details. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So a last-minute deal to avert the fiscal cliff was signed into legislation by Obama, albeit a couple of days late on the 2nd of January. Still, it gave lawmakers enough time to backdate the bill to extend the Bush-era tax cuts, at least for the American citizens with annual incomes less than $450,000 a year. This deal could be considered a win for Obama because raising tax on the wealthy individuals was a big part of his re-election campaign. However, this deal is still a temporary fix that does not include any negotiations on the across-the-board spending cuts, which was merely pushed back for another 2 months. At the same time, US is also less than a couple of months away from reaching its debt limit, which, if not raised, could cause a partial shutdown in government activities. Obama has previously requested that the debt ceiling be raised for 2 years, but that was rejected by the Republicans, who viewed the debt ceiling as a leverage point to force tough spending cuts on the Obama administration. The concerning thing is that it seems like some Republicans are even open to the idea of forcing the US to a temporary partial government shutdown just to be able to gain the upper hand in the negotiations. This reminds us of the bluff played by Obama administration during the fiscal cliff negotiations, and it seems like the Republicans are coming back for revenge after not achieving anything regarding spending cuts in the fiscal cliff deal. For the market, it means that the showdown in Congress will likely cause more uncertainties among investors. And just like the fiscal cliff, there will probably be no compromise until the very last minute, or even after going over the ceiling if Republicans really forces a temporary government shutdown. So that could be a pullback for the stock market. In terms of economic news, the last couple of weeks have been quite positive with the release of the non-farm payroll, the ISM manufacturing, and the non-manufacturing PMI. The non-farm payroll for December was slightly better than expected at 155,000. But we can't say that this is a robust figure because in a healthy economy, we expect monthly jobs growth to be above 200,000 just to cover the natural growth of the population. Nonetheless, the economy is just slowly crawling out of the slump, and it is positive to see jobs growth being consistently over 100,000 in the last 6 months, despite all the uncertainties in the US regarding the election, the hurricanes, and the fiscal cliff debate. The ISM manufacturing PMI, which dipped slightly below the 50 level last month, also bounced back up to 50.7, where it indicates that the manufacturing sector in the US was expanding moderately in December. This is perhaps a sign of reassurance given that there was still so much uncertainty with the fiscal cliff last month, and now that many of the corporate tax deductions have been extended by the fiscal cliff bill, there should be more activity sprouting up in the manufacturing sector over the next couple of months. The service sector was also quite reassuring with the ISM non-manufacturing PMI picking up again to 56.1. This handily beats the expectation of 54.2 and puts growth in the service sector at the fastest pace since March. All in all, we think that the economy is proving to be rather resilient despite all the uncertainties, and we see it gaining positive momentum in the next couple of months. However, not all the news were positive as we saw with the release of the latest Fed minutes. According to the minutes, several Fed officials were discussing the possibility of slowing or stopping bond purchases in the second half of 2013. This was a stark contrast to what was believed to be QE to infinity, and the market reacted negatively to this because of the change of tone by the Fed. We don't see this as a big threat to the economy because we think that the Fed would only remove stimulus if they are completely sure that the economy is capable of standing on its own feet. It has not shown any signs of that yet, and perhaps it could even be a good sign that some Fed members are considering early withdrawal because it suggests that they are seeing strong momentum in the economy. In Japan, governments are stepping up on course for more aggressive actions to stimulate the economy and weaken the Japanese yen. Firstly, there were reports by several Japanese media that the new prime minister is planning an additional 12 trillion yen of stimulus to revive growth in the Japanese economy. Then, the Japanese finance minister also said that they plan to use the foreign exchange reserves to buy European bonds. Now, this would help to weaken the yen in two ways. Firstly, to make this transaction, they would need to buy euro and sell the Japanese yen. Secondly, by helping to stabilize the bond market in Europe, it would also help to reduce the level of fear and risk aversion in the market, and thus decrease the demand for the Japanese yen as safe haven currency. To add to that, Shinzo Abe also urged the governor of Bank of Japan again to double the central bank's inflation goal to 2%, which means they will need to engage in more monetary easing, and a high inflation rate also helps to weaken the Japanese yen. We think these are evidence that the new government is serious about stimulating the economy and to weaken the Japanese yen, even at the risk of the country's creditworthiness. Therefore, we think that the dollar yen would still have more upside, even though it has been bought heavily in the last couple of months. Unless, of course, we start to see some signs that the Prime Minister is backing down on his approach. But currently, it seems like he is quite serious about stimulating the economy. Now, Alcoa kickstarted the earnings seasons on Tuesday with a solid fourth quarter earnings report. So far, only a handful of companies in the S&P 500 has reported earnings, so it is still difficult to get a feel of what fourth quarter would be like yet. Nonetheless, seeing the analyst estimates have dropped down to very low levels over the last 3 months, it might not be too difficult for companies to exceed expectations, and that should be positive news for the stock market. Well, we shall see in the next few weeks. And that's all for this week in the markets. We'll have another update for you next week. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.